Now, a lot of people are looking at one way of investing as themes. There have been themes from income to ESG to tech stocks and so on, to talk about how you can incorporate investment themes into a diversified portfolio. We have Cameron Gleeson. Cameron is a senior investment strategist with BetaShares. Please welcome Cameron.
Thank you very much, David. I'm just not wondering if I go to the microphone or not. I think I will. I'll adapt Tim's approach, active but low cost. We'll talk today about thematic investing, but I want to talk about it specifically in regard to how to think about incorporating investment themes into portfolios. The last year and a half has been turbulent for markets in generally, and growth exposures, thematic funds are growth-oriented exposures. So it's certainly important to sort of think through the ramifications there. Really briefly, why thematic investing? Well, one of the obvious reasons why you look for thematic funds or investment themes is to add structural growth to your portfolio, something outside of cyclical equities. Beautiful. And one thing I would say, and we'll talk a little bit about this, about valuations and the market cycle, but when you are accessing companies that are leveraging structural growth, their revenue and ideally their earnings are less oriented towards the business cycle, and that can be a powerful diversifier. It also enables you obviously to add things into the portfolio which aren't necessarily well represented into your core, depending on the approach to portfolio construction you use. And from a client perspective and also from an advice perspective, we've found that over the last year and a half, certainly in the high net wealth and the private banking space, a lot of advisors have looked to replace high-cost active managers that they may hold as a satellite with a passive thematic exposure that is lower cost, diversified across the thematic, but really taking that investment decision in-house. Across the advice spectrum, we've seen that a lot of advisors have found clients that come to their advisor with a particular idea. I really want to get exposure to cybersecurity. How do I do that? And one of the positives of that is when a client, can see structural change happening in their everyday lives, they typically, when they want to include that in their portfolio, seem to have a higher level of engagement with their portfolio. And if they're thinking about these sort of things in the way that we think is most appropriate, they're looking at a longer term time horizon. And this can be very helpful in terms of how we think about, conversations with our clients, getting away from that churn and burn in the portfolio to a multi-decade theme. So, I guess there, a client comes to you with that idea, cybersecurity, how do you look to incorporate it? And the approach there is very important. But starting just with, your typical Australian portfolio, if you look at efficient market hypothesis, even if you loosely agree with it as a structure for thinking about building portfolios, you'll note that, a typical Australian diversified portfolio might have about 50% of your equities in Australian equities, or even maybe 40% of your equities in Australian equities. And the makeup of our market is clearly very different to the US. I just highlight the two largest sectors in the two markets. One is clearly value or cyclical oriented, and the other is clearly growth oriented. And I guess, the point that I sort of make around Australian equities is our home country bias is somewhat inconsistent with that efficient market hypothesis. Like, why is the best risk return portfolio in Australia going to be, essentially clearly weighted towards certain segments which are value-oriented versus a global portfolio which is very much growth-oriented? And I'm not necessarily saying that one approach is better than the other, or one sector tilt is better than another, but if we think that we want to add more growth exposure into what is quite a cyclical Australian equity exposure, then one way to do that is through thematic exposures. So just briefly, when we're talking about thematic exposures, the traditional view of investing is to look at the economic cycle, to look at where we are at the cycle, and look at historical patterns. What sectors have done well in a recession. We might look at healthcare. We know healthcare has been defensive in the past. It's likely to be defensive again. In a early sort of recovery period, typically we'll see steepening of the yield curve, and banks, although some of the US these days are a little bit different, seem to play a game of basically lend low and borrow short. They benefit from that stage of the cycle, and then energy stocks tend to do well when commodities run typically sort of into that recovery stage and later in the cycle. And so that's that sort of typical view of trying to predict where we're at in the cycle and therefore looking at historical trends to decide what to invest in next. Investing in investment themes is fundamentally different. You're looking to really leverage structural change and ride that change to be somewhat disconnected in terms of the underlying business earnings to that cycle. And a really good example of that is just to compare the quarterly earnings from Microsoft, which is in orange here over a 20-odd year period, versus ExxonMobil. And look, if you look at the grey line, like the cyclicality in Exxon's earnings, or revenue and earnings are really obvious. They're in a mature market. There's not a whole lot of new customers that you're getting as an energy company. The size of that market is really dictated by things like geopolitical tensions, obviously, but the size of the economy. They're kind of capped out. Compare that to Microsoft, a company which has managed to really leverage into structural growth themes, whether that be enterprise, cloud, gaming, and alike. And the benefit you get from investing in a company which is able to do that is that compounding level of revenue and earnings over time. And if we look at the underlying return on equity or profitability, the margins on these companies, the profitability of that Microsoft earnings stream is far higher than that of ExxonMobil, which goes in very big swings and roundabouts. Now, obviously, getting back to where we're at and what sort of a turbulent year and a half we've had in markets, when we're thinking about thematic investing, I think it's important to firstly take a long-term view, but secondly, really to focus in on earnings and have conviction on the earnings of those underlying companies. What we've seen over the last sort of, 2022 was a story of bond yields hurting valuations. Now, this is just some data here in the middle of these two pie charts we did, looking at the drivers of index returns for US equities over a long-term time period. And at a macro level, you can look at stock price returns and see there's two factors that essentially drive returns, being changes in valuations and then changes in earnings or earnings growth. Now, over a short-term time period, valuations, so PE ratios, will have approximately half contribution, or the attribution of changes in valuations is approximately half of all stock price returns. So earnings, 50%, valuations about 50%. When we go to a longer term time horizon, earnings tends to dominate. And the reason for that is somewhat intuitive. Valuations are driven by the risk-free rate and by investor sentiment. And those things are largely mean reverting, whereas earnings compound over time. So that's why earnings, as a long-term perspective, will drive overall outcomes. And that's what we'd say is the key when thinking about long-term investment themes. I'll talk a bit about how we think about investment themes. So our approach when we're looking to build an investment thematic is to look for an area where we think the structural growth underpinned by a number of we see three key structural drivers, but we want to see longevity created by those structural drivers. We also need to ensure that there are enough companies that are listed in that world that have appropriate level of exposure to the investment theme. And obviously we're an ETF provider. We're not a venture capital investor. So this is a challenge for us, is ensuring that the theme is mature enough that we do have that liquid universe of available stocks. And then finally, we need to have some level of, relatively high degree of confidence that the company is going to be able to monetize that theme. And our approach is really to take a passive view, but to look for companies that have a level of purity in terms of their exposure. There's various ways in which you can do that, but we want to ensure that we're not introducing some secondary risk. We want to keep this as pure as possible, and we'll talk about why that's important in portfolio construction. With that, and this sort of does dovetail into what Tim was saying, we do believe in diversifying across the theme, ensuring that you do not have too much stock-specific risk. One of the reasons for that is because typically these indices that we track for a thematic ETF are passive. They're rules-based. And so diversifying stock-specific risk is important there, not only for the diversification of the risk angle, but also because of that winner-takes-all dynamic. And I've got a chart here, and this is actually very similar to what Tim presented, this dynamic in equity markets. when you look at cross-sectional stock price returns, and similar to what Tim had, but this is a study from Bessenbinder, quite a well-known study. If you look at long-term stock price returns and their contribution to overall index return, it's actually only a very small handful of stocks that give you all of the outperformance of the index. So he compared from back in sort of the 30s through to today, the return of the index, and said, look, that handful of stocks that produced any outperformance above the risk-free rate was 4% of the entire stock universe. And in fact, the most likely outcome is the stock goes to zero if you look at any sort of extended time horizon. And so, what that tells you is that there's that small handful of winners that you really want to make sure you hold if you're going to participate in that. So the approach to thematic investing that we would espouse would be to look to hold the theme in its entirety. It's very difficult to pick winners. There is a high degree of failure in emerging themes. And, in that regard, capturing the theme in its entirety is where you want to be. Riding market capitalization, riding momentum is the way to profit from that theme, because the winners will take all, dominate. And it's somewhat akin, I've got a quote there from Peter Thiel, somewhat akin to, the power law dynamic that we see in venture capital. Just a snapshot of, this doesn't even include all of our thematic funds, but I mentioned before the three key structural drivers we see are technological innovation, climate change, and demographics. And we think that's important, that your theme must be anchored in, ideally, more than one of these themes, but at least one of these themes to see that long-term, multi-decade growth. I'll briefly touch on a couple of these funds just to give you a taste before we look at a portfolio. But one of our most well-supported thematic funds is HAC. This fund's been around for a long time. It's strongly outperformed MSCI World. And what's I think important is the resiliency of the returns of this fund throughout market downturns. And clearly, it's almost every development we see in terms of, cybersecurity gives a net tailwind to the companies which have products and services essentially protecting corporates, individuals, and governments. You just have to look at, for example, ChatGPT, generative AI. You used to get a spam mail which was badly written from a Nigerian prince with typos and alike. Using generative AI, a cyber criminal can attack at scale a wider network, create human-like interactions without typos, much better penetration of a corporate. And so companies in HAC, some of the leaders there, are developing solutions to basically help corporates protect themselves against that. So all of these developments, the fact that digital data is growing annually at 60% per annum, just increases the opportunity for criminals. And we've got somewhat of an arms race here where corporates need to or are forced to increase their spending. It's no longer a negotiable. So clearly there's a strong underlying driver there, and unfortunately it does seem like those tailwinds are only getting stronger. Another one of ours is our BetaShares Energy Transition Materials ETF. Look, there's a number of dynamics in the energy transition. One is about access to raw materials. You might have seen that Australia followed the US, released a critical minerals strategy to help fund the development of some of these producers. But another really interesting dynamic, and this is particularly applicable to thematics, is if you look at battery makers, EV battery makers, they adjust the battery chemistry, the mixture of different elements, and they've done that over a period of time based on the availability and the cost of the raw materials. And so holding a diversified basket of those miners of particular materials can make a lot of sense and really ride the wave or the increase in use of the materials as a whole, rather than having too much exposure to, for example, nickel, if alternate battery materials become more prevalent. And then finally Asia, and I'll just talk about Asia briefly. Look, this fund performed incredibly strongly until we saw somewhat of a implosion at Alibaba with Ant Financial, and we saw a lot of hardship for holders of this fund over a period of sort of 2 years, especially when other parts of the market were still performing well. Interestingly, we didn't see a drop-off or a sell-off of investors. The units on issue remained the same. We had lots of calls with advisors, talking them through what's going on in China. I think we're very open and honest about the prospects, but we didn't see that on the whole people sold out. People were using a long-term view in terms of the way they were using this fund. Where we're at now, and this is where it gets interesting, is the use of a thematic that gives you a lot of diversification. And China's clearly in a different part of the cycle. If you read through that table there, completely disconnected from the West in terms of the economic cycle. And that's interesting from a diversification perspective. So, looking at how we might use thematics in a portfolio, look, there are different approaches, but the one that we would ascribe to is we believe that you should reserve the bulk of your core portfolio for low-cost passive and low-cost smart beta where available. That's going to be, so that robust core that needs little tinkering with over the long term. But where thematics can make sense is to add as a satellite exposure. The good thing about thematics is that they're, generally speaking, lowly correlated to the core, but they have higher volatility as individual funds. So this is sort of interesting. When we look at blending thematic funds into a core with that lower correlation but higher volatility, we can actually see beneficial outcomes in terms of risk-adjusted returns, provided we don't make those thematic funds too big. So I have an example here, obviously not a recommendation, but of using 3 of our funds, and I've used Asia Hack. I didn't use XMET because I didn't want to use a fund with overly strong, historical performance, just to demonstrate how a portfolio may, essentially look and feel with such funds. So the first thing to do, of course, is to get conviction over the long-term prospects of the investment thematic. If you're talking to, whether it's an active manager or an ETF manager, ask them about the fund, ask them about how the particular companies are included in the index or the fund, get an appreciation for what's going on, and you need to have conviction on that long-term revenue and therefore ideally earnings growth. And I just show here the forecast revenue growth for the 3 funds on the previous slide versus revenue growth for ASX 200 and MSCI World. Typically, we see global equity markets or Australian equity market typically will grow by about GDP in terms of revenue over the cycle. Earnings are a little bit different, but you see there obviously that uplift, and that's that growth we're looking for. Here I show the total returns over the previous 3-year period, as well as the volatility. And so out of the 3 funds, Drive, Hack, and Asia, 2 have had performance above MSCI World, above Australian equities, Asia below, on average, basically about the same. But as I said before, the volatility actually much higher than, for example, Global World there, in terms of that volatility. But when we look at the correlations, we start to see something interesting. Now, the correlations between, for example, Asia and MSCI World, and Asia and A200, are actually incredibly low for equities. We've seen that disconnect over the last few years, and again, we're now in a different part of the cycle. And obviously, we know there's a benefit to diversifying into global equities, but the diversification benefit there in terms of that correlation is much higher than you typically see in a thematic. So what does this do to a portfolio? Well, the first portfolio I've got here is just your straw man. So I've used just MSCI ACWI, so All Country World Index, A200, which is our Australia 200 index, and then the Ausbond Composite as a bond default there, and showing historical returns 7.4, volatility of 13.8. Now, if I add just a little bit of 3 of these funds into the portfolio, I don't want to focus too much on the total return, but we can see there that the volatility in fact has dropped. So this is part of the benefit of that theme-specific risk being disconnected from broader market risks. And again, if I then maybe increase that to 4% each, typically I think 2% is probably too small for the amount of due diligence you want to do for an ongoing holding, then we see again that drop in that portfolio there. And clearly what we're trying to drive for by adding thematics is outperformance, but combined with the drop in volatility, we see there that increase in the Sharpe ratio. Look, so that's they're the slides that I had to talk through today. I'm happy to take any questions on any of our funds, on markets, on how we think about portfolio construction with thematics, or just more broadly.
Hi, Ray from Daintree Wealth. You mentioned inclusion factors and things like that. So when you're, I guess, coming up with new indices and things like that, what are the types of inclusion factors that you look at?
Yeah, it's a really good question. It's sort of where we spend a lot of time. So if we look at XMET, that Energy Transition Metals ETF, we spent about a year trying to figure out the best way to build that index. For that index, we worked with NASDAQ, who in the end, we worked with a lot of index providers, but with NASDAQ, who partner with a Canadian active asset manager called Sprott, who you may know, the Uranium Trust in Canada. They're a resource energy transition expert. And their role was to essentially identify what are the appropriate metals that have both supportive demand and supply aspects, rather than just picking the 12 metals that are in the IAE report, right? So, there's an element there where there is a subjective decision made up front as to what the right metals are, but then we have strict rules that essentially look through companies at granular level to say what proportion of their revenue for each of these companies are driven by those particular elements or metals. Yeah. Yes, they do, of course. Yeah, so we will either rebalance. Typically, you rebalance either semi-annually or quarterly. There's a lot of that goes into thinking about that, what turnover that creates, how quickly the industry is adjusting. But you're always looking to adjust. But revenue is one way that you'll look for purity. You want to look for purity in terms of that theme. There are other indices where the index, where that industry might be a bit different. And for example, HACK is a good one where there is an expert panel, which is a US tech association, the CTA. They're very large, basically an industry body who actually select the companies for HACK because of the nature of that industry and the difficulty in terms of picking revenue purity. So the approach does have to vary, but you will always be looking to rebalance to ensure that you're capturing a theme in the best way possible, according to a set of rules. Of course.
Cameron, you showed a slide that said, I think it was 4% of stocks that outperformed the risk-free rate long term, and we heard similar things from Tim earlier. So if I put 2-3 themes that I like in my portfolio, how do I pick which ones are going to be in that 4%, or can I be sure of that?
Yeah. That's it's a tricky thing to do, isn't it? Especially when things are evolving, because you're talking about long-term returns there. I mean, that's kind of the conundrum that active managers face, is that on a probability basis, if they are not picking the entire universe, odds are against them. So they either have to be very lucky or very, very good at picking the right stocks. I think the data's sort of proven that, especially when you're looking at long-term returns. Shorter term, that skew that we see that Tim would have shown, that skew isn't as pronounced. But longer term, it's very pronounced, and it's a conundrum that the active guys face.
I've got a question about given that thematic investing is a relatively recent phenomenon. When you think about putting a theme together, how do you arrive at a sort of expected risk and return correlation with other parts of the market that you think has got long-term predictive characteristics?
So I mean, it can be difficult to to look at that and look back at correlations and alike with themes. I mean, I think our real focus is to think more about what the future's likely to look like and how this industry is likely to evolve and how we're getting that purity of exposure to those companies. Because, I mean, those correlations will move over time. Let's be honest on that. But, if you can give that purity of exposure, we know it will be lower than, for example, Aussie equities, global equities, which, there's naturally a high degree of correlation in those broader indices. Thanks, David.